The differences between two Vanguard index funds, VTSAX and VFIAX, are primarily centered around their investment focus. VTSAX, the Total Stock Market Index Fund, provides comprehensive exposure to the U.S. stock market by mirroring the CRSP U.S. Total Market Index, which includes companies of various sizes across different sectors, encompassing large, mid, and small cap companies. In contrast, VFIAX, the 500 Index Fund, focuses on tracking the S&P 500 index, comprising the 500 largest publicly traded companies in the U.S., with a predominant focus on large cap stocks. As a result, VTSAX is preferable for its broader market exposure and greater diversification. In terms of risk and returns, VTSAX has demonstrated marginally lower average returns than VFIAX, but with potentially lower volatility due to its wider diversification. On the other hand, VFIAX has delivered higher average returns, attributed to its concentration on large cap companies, and has shown a tendency to outperform the broader market in the long run. Although with slightly higher volatility, individuals prioritizing investments in the largest U.S. companies may prefer VFIAX. The expense ratios of the two funds represent the yearly fees charged for managing and operational expenditures. Although both funds have lower expense ratios, VFIAX generally maintains a slightly lower expense ratio compared to VTSAX. This difference may appear minor, but it can accumulate over time, particularly for investors with long-term investment horizons, making VFIAX more considerate due to its lower expenses, which can lead to higher returns over time. Despite their differences, the two funds share some similarities. Both are passively managed index funds offered by a large investment management company, and they are tax efficient due to their passive management, which does not generate high amounts of turnover or capital gains distributions. Additionally, both funds are designed to provide low-cost exposure to the U.S. stock market.